All right, everybody, welcome back to another edition of Market Talks with Dr. Stocks. This is Dr. Tom Carr, aka Dr. Stocks at drstocks.com, drstoxx.com. And if you're interested in joining me and a really nice group of traders of all different levels of experience, go over to drstocks.com, click on the subscribe button, and you can join us in the live trading room. This is where this broadcast is coming from. We also have a live options room, brand new, just launched a few months ago, doing really, really well, despite some crazy moves in the market. And I also have a number of daily and weekly stock pick advisories, and they've been out there since October of 2002, 23 years of doing this. And I'm still not ready to quit because I love it. I enjoy it, especially this live trading room. This has been such a great improvement in my overall enjoyment of trading. It's never fun to trade on your own. Nobody really should trade alone. Nice to have a lot of different eyes than I have to see what's going on in the broad market. Lots of smart people in our room and people who are learning and asking questions. And I just love it. It's just a great community. We're all very polite to each other and we keep politics out of it. We keep swearing out of it. We keep dirty jokes out of it. It's just a nice place to hang out. All right. Let's jump over to some charts and take a look at what's going on in this crazy market. Now, here's the first thing I'm going to do. I want to get rid of some of these indicators here. We'll just use the 21 EMA, the 50 SMA, the green line here is the 200. I've got the LRC, the linear regression channel, which is set at a 100 period look back at a 1.5 and 2.0 standard deviation, which gives us a nice pink band at the bottom. That's generally your buy zone in an uptrend. And nice powder blue band at the top, which is generally your sell short zone in a downtrend. And we've seen, this is the S&P 500, we've seen this, the angle of the LRC shift from uptrend to flat. Now it's just starting to lean to the right, lean to the south. After yesterday's new, wasn't a 52-week low, but it was about a 6-month low, and that was a nasty, very nasty move. We've seen several of these, right? It's just been a nasty fall on mostly fear of tariffs and trade wars and inflation creeping back up again and the Fed not being able to cut rates despite possibly a recession. All kinds of worries the market is worried about. And as it usually does, it probably has overshot the fear factor, the reality of what we're actually looking at here. But my map of least resistance is something like this going forward over the next 6 weeks or so. Modest bounce up into the underside of the 200 period moving average to retest that level and then back down in April. That will probably take us up to somewhere in the middle of May for another leg lower, a little more pricing in of some tariff fear, possibly recession, et cetera, et cetera. That, however, we have to really keep an open mind to this. That is not set in stone. Of course, no future market move is ever set in stone, but I do think that it's possible. We'll either get Trump backpedaling a little bit on his tariffs or a lot, which would be great, or we get some kind of negotiation between himself, Canada, Mexico, Europe, China, that backpedals on their side, and then we can backpedal on our side, and then we can get back to just trading the old market, right? Just trading on economics and growth and all the good stuff that the market is representing. But we're not there yet, and we still have a lot of work to do. All right, I want to show you a couple of things, a couple of nifty little tricks that you should have in your arsenal that will help you get a better read on the market, have a better understanding of dynamics and trends and reversals. Here's one thing. So if you you go over to here, this little candlestick thing, and this is TradingView. So if you're not using TradingView, you'll have to translate this into the charting package that you use. Click on the little candle thingy there, whatever you want to call that, and scroll down to Heiken Ashi, which is I think, Japanese form of candlestick charting. And what the nice thing is about the Heiken Ashi is that it makes very visual the trend that you're in, and it also makes very visual the reversal pivot points The trend going down is usually the same color, red, going up, same color, green. And if you get a string of greens going up and then all of a sudden a red, that's a warning sign, right? A sell signal potentially. You get a long string of reds and then you get a green potential buy signal. You can see long string of reds, but today, despite a pretty nice move higher, is still a red, right? The market's actually up and it's up nicely. We're up not only above the open, but we're well above yesterday's highs. Pretty sure we're above yesterday's highs. But here's what the Heiken Ashi does. So every bar that you get opens in the candlestick, not in the actual price, but in the candlestick, opens at the average price of the previous bar. Open, high, low, and close. You take those 4 pivot points, those 4 data points, take an average of those, and that's where the subsequent bar opens up. Now, if the actual price closes above that average price, it turns from red to green. If it closes below that average price or even at the average price, it will stay red. And that's why we're still red today, because we're not yet above the average price of yesterday's range, at least on a closing basis. Now, we still have a little time. We've got over an hour and a half of trading. That could change, but that's where we're at. Let's count these numbers of candlesticks. I think we had 16 yesterday. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. It was 15 yesterday, 16 today. And I tell you what, I yesterday went back, I found one other 15 bar string like this, and the 15th bar was the last one, and the next one was a green, and then it was a very strong up from there. And I'm not exactly sure when that came. It could have been the August low, might have been the April low, could have been the October 23 low. There are several bottoming pivots where that kind of thing could have happened. 16 bars in a row, though I don't think you'll find one going back 10 years, 15 years. Maybe no, not even 2009. 2008 rather, was the really, really bad year, the Great Recession, and everything was just falling. But there were so many nice little relief rallies in there. It was like 3 or 4 days down, really big down, and then a couple of really big days up where you'd make back 50% of that downslide, and then 3 or 4 days down and 1 or 2 days back up really strong. And then it was like that all the way through 2008. It was a crazy year, absolutely crazy year. But things started to settle out, bottom out. We got a nice base in 2009, January, February, and middle of March, and that's when we hit the bottom. 666 on the S&P 500. I'll remember it very, very well. March 9th, I think it was, or 13th, or somewhere in there, right around the same time we're at here. This is March 14th today. And it was all upside, all up from there. So we're kind of in that same situation. 16 bars in a row of downside where we can't even close above the average price of the previous day. That's how sharp this pullback has been. You're going to see the same thing for the NASDAQ. Let's see. Yeah, we're still on a red bar. This might even be more than 16. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. 17 bars. That may be a historical record. That might be. I don't know. If someone can find out for me, go back into history and see if you can find a longer string of red or green bars. I'll take either one. 17 bars in a row. Now, does that mean it's going to go up from here? Not at all. We could get 6 or 7 or more bars down to the downside. It's like, you go to the casino and you play the roulette table, red or black, and you see, oh, it's been black for 12 whatever you call it, spins in a row, and so you're going to bet the house on black because it's bound to be black, right? No, every time the table spins, it's a 50-50 chance. Well, the same is true here. However, we're also dealing not so much with a purely random spinning of the wheel. We're also dealing with economic vectors of influence that aren't random, that are known and can be known and can be reasonably predicted going forward. So with all of that said, I do think we are again near or at or even past, now that today is up, an intermediate term, or let's just call it a short term bottom with a relief rally coming up, probably up to the 200 period moving average, if not higher. And then we get the rollover in April, leg lower. I don't think that's going to be avoided without any major change in the tariff news. And then by the time we get out to mid-May or so, things should be fairly well resolved. We also may have two cuts. We've got a FOMC meeting next month. Not likely that the Fed will cut then. Things are still pretty good in the economy, the overall economy. Should he cut? Yeah, probably, to avoid putting us into recession and against the background of tariffs. But I don't think he will. He'll be very dovish, but he probably won't cut rates. And then we'll probably get our first cut in May, maybe another one in June, and a third possibly if the market isn't strong and the economy's not strong. We'll get a third one by December. All right, so that's the NASDAQ. Take a quick look at the small caps. So the small caps are always a good read on the risk on trade. It's a good read on falling rates. It's a good read on, well, I don't know, all the stuff that helps the stocks that really rely on growth, future growth, because they don't really have much in the way of present growth. All of those, like falling rates, cheaper dollar, still strong labor market, and lower labor costs. That's huge, right? Lower labor costs. All of those help the small cap index, and usually the small cap index is typically the first index to fall as things get a little squirrely, and as the first index to start rising. Well, it hasn't started rising just yet, so we'll have to wait and see. How many red candles we have here? 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17 again. All right, so let me get over to the regular candlesticks, and I do want to show you a couple of nice things here. There we go. So let me put on, I'm going to go back to, let's go back to the S&P 500. One of the nice things you can do, that divergence indicator that I showed you, if you go to the indicator itself, go to settings, and go to inputs, you're going to see the list of indicators that can be included in its signals, right? So you've got, I don't know how many, 3, 6, 9, 10. You've got 10 of them. So potentially you could have 10 indexes, 10 indicators that show bullish or bearish divergence. Typically, I've never seen a 10. I've seen an 8. We just saw an 8. But I don't think you get more than 8, frankly. I've never seen anything more than that. But here's the thing. When you're starting to get up to the top, right, up to the top of an index, 52-week highs, all-time highs, which is where we were not too many weeks ago. Just 4 weeks ago, we were up at all-time highs. The first thing that starts to flag some weakness there at the top, especially if you get up to, let's say, I don't know, I'm just going to make some ordinary numbers here. Let's say we got up to 6,000 SPX, and then a month later we're at 6,010 SPX, and then a month later we're at 6,020 XPX. The thing that's going to mark those as legitimate tops and not just a bull trap that rolls over is, in a single word, volume. Volume. You want to see strong volume at those tops. And if you're starting to see a decline in volume, if you're starting to see bearish divergence in volume indicators, that's an early warning signal that not all is good here at the top. Now, the thing about this indicator is that I can get rid of the MACD, which is a price-only indicator, the histogram, relative strength, stochastics, CCI. These are all price-only indicators. And momentum, I'm going to keep on the OBV. I'm going to keep on the volume-weighted MACD, the Heiken money flow, which is flows in, flows out, and the money flow index. Keep on those 4 because those are all dealing with volume. And then we can see what it looked like up here at the top. Here we've got 3 tops, 3 different bearish divergence readings. Now, we only have 4 indicators on here, so if you got 2, 50% of your indicators are flashing bearish sell signals. So tip number 1 is, when you're getting up at the top and you're wondering, is this a legitimate top, Keep the volume indicators on there. Get rid of everything else because some of the price indicators may lead you astray. And when you start to see these repeat themselves, like here, yeah, it's time to get a little cautious. Now, did I do that when we were up there? No, I didn't. I mean, we were starting to get light, and then when it came down here and flashed this reversal just below the 50 period moving average down here in the pink zone, and the LRC was at a nice uptrend at that point. We were down here in the pink zone of the LRC. We were thinking buy the dip, buy the dip, buy the dip. And then it gave us a nice flashing dip buy signal off the 200 period moving average with that inside day bar and then a hammer candle. And then it was just boom, one less leg lower. So yeah, we were just nibbling. We weren't doing any heavy trading, but it was clear buy signal in an uptrend that didn't follow through at all. And that's why we use stops, right? It's trading 101. Okay, so the other indicator I wanted to talk to you a little bit about, one last thing, I've done this many times, but the RSI, which I have down here, one of the nice things you can do is put a trend line underneath the tops of the pivot highs of the RSI, and the breakout that we're getting today can potentially give us some follow through in price. Right? That's usually what it looks like, just like this. When you have a reversal from a long downtrend to at least a little bit of a relief rally, and I'm pretty sure that's all we're going to get. I'll repeat it again. That's all we're going to get unless the tariff macro changes. This indicator down here with all the funny colors and squirrely lines is a cycles indicator, and I'm not a cycles guy. I don't trade Elliott wave. I don't use Gann. I rarely use Fibonacci ratios, and I haven't ever used cycles. But I have a friend in my pro trader group. I'm in a group of guys men and women who trade for a living, and we share ideas. We bounce ideas off of each other, usually every market day. We can share most of what we're trading with each other, not always. Most of us are kind of keeping our cards close to the vest. But there's a guy in my group who does cycles, and he was out the other day saying that his cycle indicator was just lining up very nicely with these big moves in the market. So, when you had a cycle, this is an intermediate term, this orange line, when it hits a peak and then starts rolling over, you're looking at an intermediate top in the waves that the market makes and moving down into something a little lower, right, on an intermediate term basis. The purple line here is the long-term basis. And of course, these waves are going to be spread out. So let me just a brief thing about cycles, because I don't understand it. I don't know the science behind these, but these different cycle colors here are different, not amplitudes, but what do you call the distance between waves? There's a term for it. I should remember that. But you have tight little waves, right? Short term. You have intermediate distance between ups and downs. That's a middle term. And then you've got big, long waves that roll like the sea, up and down, but lots of time between the troughs and between the peaks. And that's your long-term view. So his thing is that he likes to see these line up, right? So that you get a lot of peaks going together, that would be a top. You get a lot of troughs going together, that's a bottom. And he was out a few weeks ago, this is what caught my attention, saying that there was a lineup right about in here, right around early February, a lineup of these longer term waves with the shorter term waves, and it was a time to get short. Well, he was wrong for about 2 weeks, and then it was all downhill from there. Turned out to be right. Now, he's come out and said they're starting to line up on the downside, which means starting to bottom out and ready to rise. And some of these shorter term waves are already turning higher. Okay, yeah, we'll take it for what it's worth. But let's just see if it rolls out and works for him. You're going to see the same thing down here on the Nasdaq, right? You've got the long term, the purple, down at the bottom. You've got I don't know what these different ranges are, but this orange one is a little shorter, already bottomed out, starting to rise. The green one, a little shorter still, already starting to rise. The blue one, which is shortest of all, is rising quite sharply already. So maybe we'll get a longer term But I tell you what, not going to get it without some change in the political background. Okay, enough about cycles. Now, let me show you a couple of charts that I do like. We have shared these with the room APP. Here's a little tip as well. And I didn't notice this yesterday. This was someone in the room, live trading room, who brought this to my attention. And then a guy that's in my pro group on Twitter also mentioned it at the same time. And I'm thinking, okay, when things line up like that, pay attention. So app, right, deep down, but it bottomed yesterday. The market bottomed. App bottomed on Monday, right? That's Monday. It hit the lows of the week on Monday. The S&P and the Nasdaq hit the lows of the week yesterday. So that's already bullish divergence just in price. You've had it outperforming, right? The last 4 days it's been moving up. The S&P, the QQQ, moving down. The S&P, as we saw, is in a slightly downtrending LRC, linear regression channel. The app is still in an uptrending LRC. If you looked at the, in fact, let's do that. Let's look at the, where did it go? Here it is. Look at Market Surge, which is a very good tool for analyzing stocks, and it's especially very good if you are kind of caught between a couple of choices. You're not sure which is the better choice. Put both of them into Market Surge and come over here and look at this little box. You're going to get a comp score. That's the overall score of the market, of that stock, rather. 99 is as good as it gets. App is a 97. Look at the timeliness rating. That's your technical setup. It's an A. Doesn't get any better than that. Look at your SMR rating. That's sales growth, margins, and return on equity. When all those three things are strong, you've got strong pricing power, a moat, as Warren Buffett would say, and that's at an A. Doesn't get any better. So all of that is very, very good for app in terms of the fundamentals of the company. And then you've got this price outperformance. You've got the breakout of the RSI, right, over the pivot highs. And look, you've got the long-term trend. I don't know if this is material or not, but the long-term trend is already down and is now starting with this little pop to move higher. The green intermediate term, the blue intermediate term, the yellow, they're also starting to curl higher. So all of that looks quite good for app. Another tip off yesterday, market was making new 6-month lows, and app wasn't even taking out Wednesday's low on Thursday. So that's a +2, bullish divergence. You're going to see something very similar with Reddit. I'm not really a fan of Reddit as either a company or a stock, but it is an exciting stock to trade, and it's quite similar to app here, right? We've got the RSI breakout. We've got both of the longer term cycles, if this makes any difference at all, down here at the bottom, curling higher. We've got outperformance. It bottomed out like app on Monday. It did take out Wednesday's low, fill the gap, but it's not hitting 6-month lows. It's hitting two-day lows, right? So a very big difference. And then an inside day bar today. So inside day bar, here's an inside day bar, here's an inside day bar. And when you see them at the bottom of a downtrend, pay attention because they are a pretty good marker. I would say the edge is maybe 60%, 65%, maybe. That when you get a long downtrend, you get an inside day bar, that is the bottom. Short term or intermediate term, you're going to have to take it day to day, but that is the bottom. It's not going to go any lower for at least a little while. And that's what we had on Tuesday and another inside day bar today. So pay attention. Pay attention. That looks good. That looks very good. I'm looking for another inside day bar. That might be one right there. I don't think so. Low 156. And, no, it's not. The low is lower. Okay. All right. Just a quick look at the mags, and I'm gonna stop the video, and we're gonna look at our diagonal debit spread positions. Gonna add a new one today. Look at all the mags, all green, 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 green. Who's strongest? Looks like NVDA. No, Tesla. Whoa. So in the room, the live trading room, we're long Tesla, we're long NVIDIA, and we're long Qualcomm. And in the options room, we're long, I think we're still long Facebook and we just banked Avgo and NVIDIA in that room. But I think I don't want to say because I may not be correct whether we're long Google or not. But anyway, um, yeah. So Tesla looks still questionable. I have to say questionable, but it's like we saw with Reddit, like we saw with App, it's outperforming. Yesterday was not a new 6-month low; it was a new 2-day whatever it was, and it hit the lows of this downtrend on Monday, and it's been bouncing back ever since. And today looks pretty decent, and it's leading the mags. And you've got you've got 3 cycles down at the bottom, all starting to curl higher, and you've got a fresh RSI buy signal as well. So, and this has been a long downtrend, long downtrend from pretty much, the election was back here. It was a good month for Tesla, and then it was all downhill from there. Okay, so bounce back imminent. How far is it going to go? Maybe 280. I would be surprised if we get all the way to 300 before we get a little bit more danger going on there. NVIDIA looks pretty good. So this is a sharp bounce back again. QQQ yesterday was at 6 months lows, not NVIDIA. Outperformance, a higher low yesterday than on Wednesday, another higher low today than Thursday. This looks good. Now it's stuck at the 21 EMA. And typically on your first bounce back after a long downtrend, that's about as much as you're going to get. It rolls over, it prints a lower high. I'm sorry, let me try that again. A higher low. Let me draw this out, right? Sharp downtrend. Relief rally bounce into 21 EMA, comes right back down again. Bears think they're back in charge, but nope. It was just a little bit of some back and fill, and then you get the breakout move over that high. And when that happens, you typically get the end to the downtrend. So we're hoping that's the end for that one. We are long Qualcomm. It's down here at support. Big move today, 3-bar reversal. Look at these cycles all lining up higher. RSI showing very clear bullish divergence. I don't know why. Oh, it didn't show up on my indicator because I toggled it off. But it would show up. Microsoft still a no-go zone, but I do like Amazon. Amazon 190 is your key level. Resistance, 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 resistance with a bull trap. Here's resistance with a bull trap. More resistance, resistance, resistance. Finally, the breakout. And that was a breakout, a mother of all breakouts, right? Big short squeeze. Here's your short squeeze right there. Here's your first pullback, and then a nice upside to new all-time highs, pull back to the 50 midline of the LRC, new all-time highs. And then everything has just rolled over with the market, right? 4 weeks down of just painful downward pressure on the market. But 190 tested on Monday, tested yesterday, both times held, bounce up today, inside day bar, bullish, fresh RSI buy signal, couple of cycles pointing higher after a deep low. And so, yeah, let's be bullish on Amazon, shall we? All right, guys, I'm going to call it quits here. And then I'll stop the video. I'll jump back into the room, and we'll do our live income play rollouts for next week. God bless everybody. Have a great weekend. We'll see you back in the room in a little bit.